Let me ask you something. When you signed up for your 401k, whether it was 5 years ago or 25 years ago, did anyone sit down and walk you through the flaws? Not the benefits, I'm talking about the flaws. Did anyone explain the rules governing your account can be changed at any time by people you'll never meet? That a significant percentage of your returns is quietly leaving your account every year in fees you've probably never calculated? That the diversification you think you have may be an illusion? That your account produces zero income for the 30 years you're building it? And that the only exit strategy built into the vehicle is to slowly spend everything you built until it's completely gone? See, nobody told you any of that because the system that benefits from your participation has no incentive to tell you. Today, I'm gonna tell you everything. 5 flaws, the ones nobody in the retirement planning industry wants to talk about, and what each one of those flaws means for your financial future. This is not meant to be doom and gloom. This is informational. And information is the only thing that gives you options. Let's get into it. My name is Adam Williams. I'm the founder and CEO of Elevest Capital, a private equity firm based in Scottsdale, Arizona. Last year alone, my firm completed over $200 million in multifamily transactions, and we added over 1,300 units to our portfolio. I've spent over 20 years studying how capital works and how the traditional financial system operates. I've had this same conversation with hundreds of high-income earners who were doing everything right and still had a retirement plan that was quietly working against them in ways they had never been shown. There are 5 flaws nobody ever told them about, and I bet nobody told you either. Flaw number 1, you have no control over the rules. This is the flaw that most people never even think about. And it might be the most important one on the list. See, the 401k was created by the government, which means the government controls the rules, all of them. The contribution limits, the withdrawal age, the tax treatment, the required minimum distribution schedule, the penalty structure, the definition of what qualifies as a hardship withdrawal, every single rule that governs how you access, use, and are taxed on your own money. And the government can change any of those rules at any time without your input, without your consent, and without any obligation to grandfather in the plan you built under the old rules. This has already happened. The Secure Act of 2019 changed the RMD age and fundamentally altered the rules around inherited retirement accounts with almost no warning and significant financial consequences for millions of savers. The Secure Act 2.0 made additional changes in 2022, and the conversation in Washington about how to address the national debt includes retirement accounts as a potential source of future revenue. I'm not a political commentator, and this is not a partisan statement. It's a structural observation. When you build your entire retirement inside a government-controlled vehicle, you're subject to whatever rules the government decides to apply now and in the future. You do not own the rules. You're simply a participant in a system that someone else controls. That's a risk most investors have never priced into their retirement plan. Flaw number 2, you're paying for performance you may not be getting. This is the best kept secret in personal finance. Your 401k is not free. It's not even close to free. And the total cost, when you add up every layer of fees, is one of the most quietly destructive forces in your retirement account. Here's how the math works. Most 401k plans charge an administrative fee, typically 0.5% to 1% of plan assets annually. On top of that, every fund inside your plan has its own expense ratio, the annual cost of running the fund. The average actively managed mutual fund charges between 0.5% and 1% a year. Some charge more. And if your employer uses a financial advisor to manage the plan, there may be an additional advisory layer on top of that. Add it all up, and the average 401k investor is losing somewhere between 1% and 2% a year in total fees. Now, here's the number nobody shows you. On a $500,000 portfolio, 1.5% in annual fees is $7,500 per year. And that sounds manageable, but that $7,500 is not just leaving your account, it's leaving your compounding. The money that paid fees this year is money that did not compound for the next 20 years. Over a 20-year period, the difference between a 1.5% fee structure and a 0.1 fee structure on a $500,000 portfolio is roughly $300,000 to $400,000 in your ending balance. That is not a rounding error. That is retirement. And here's the part that should make you genuinely angry. You pay those fees regardless of performance, whether your funds beat the market or trail it, whether the year was good or whether it was catastrophic. The fee leaves your account every single year on autopilot, silently, invisibly, never showing up as a line item that says, this is what your retirement plan costs you this year. Do you know what your total annual 401k fee is in dollars? Not the percentage, I'm talking about the dollars. Most people have never calculated it. Today's a good day to start. Flaw number 3, Diversification is an illusion. Your financial advisor has probably told you that your 401k is well diversified. You own a large cap funds, small cap funds, international funds, bond funds, spread across hundreds of companies, balanced and protected. But here's what the diversification actually does when it matters most. When the market drops, I mean really drops, the way it did in 2008 or maybe in early 2020, everything in a traditional 401k drops together. Large caps, small caps, international, it all moves in the same direction at the same time because it's all exposed to the same underlying force, public market sentiment. That is not diversification. That is the appearance of diversification with the risk of concentration. True diversification means owning assets whose performance is not correlated to each other. Assets that do not move all in the same direction when the fear hits the market. Assets that can hold their value or even produce income during periods when public markets are collapsing. The 401k cannot offer you that by design because every asset available inside a traditional 401k lives within the public market universe. You can shuffle between funds all you want, but you're still entirely inside one correlated system. Real diversification includes assets outside of that system. I'm talking about private investments, real assets, structures whose income and value are driven by operating fundamentals rather than daily market price. When you own assets that produce cash, regardless of what the S&P 500 does on any given Tuesday, you have actual protection, not just a label. The 401k gives you the label, not the protection. Flaw number 4, it produces no income while you build it. Think about this for a moment. You contribute to your 401k for 30 years, right? The balance grows. On paper, everything looks good. But during those 30 years, not one single dollar of capital is working for you in any tangible, spendable way. Your 401k does not pay you while you hold it. It does not produce monthly cash flow. It does not fund any part of your life while you're in accumulation phase. It grows or it shrinks based on market price alone. And it sits there waiting for a future moment that you hope will arrive on the terms you planned for. Let's compare that to any asset that generates actual income while you hold it. A rental property pays you every single month. A private equity investment distributes cash quarterly. A business generates revenue on an ongoing basis. These assets produce while you build, which means your capital is working for you right now, not just someday in the future. Here's why this matters beyond the obvious. When your investments produce income during the accumulation phase, something powerful happens. That income gets reinvested. It compounds on top of your original capital. It accelerates the timeline to your financial independence. And it gives you something the 401k never does: tangible, monthly evidence that your capital is actually working. There's a psychological dimension to this that's easy to underestimate. Watching a balance number on a quarterly statement is abstract. Receiving a cash distribution every single month is concrete. One keeps you guessing and the other keeps you building. The 401k keeps you guessing for 30 years. Flaw number 5. The exit strategy is depletion. This is the one that lands the hardest every single time. The 401k has exactly one exit strategy built into its design. Spend it down slowly until it's completely gone. There's no mechanism inside the vehicle for a permanent income. No structure that says your capital will keep producing after the principal is consumed. No design feature that protects against outliving the math. The entire model, the 4% rule, the 30-year runway, the withdrawal schedule, assumes one thing: you will consume everything you built and then you'll die. That is the plan, literally. That's what the system was designed to produce. And here's the cruelest version of this flaw. The investor who does everything right, who saves the most, compounds the longest, builds the biggest balance, is the most exposed to this problem. Because the bigger the pile, the more anxious the depletion. Every market drop in retirement is now a crisis. Every healthcare expense is a recalculation. Every year that passes is a year closer that balance might not last you. You built something significant, and the system hands you a withdrawal rate and tells you to spend it down as slowly as possible and hope the math works out. That's not a legacy. That's a disappearing act dressed up as a financial plan. So look at those 5 flaws together for a moment. You have no control over the rules. You're paying fees that silently compound against you. Your diversification does not protect you when protection matters most. Your capital produces nothing for the 30 years you're building it. And the only exit available is slow, anxious depletion. And none of those are accidents. None of those are bugs. They're the features of the system that was designed to keep your capital inside a structure that is easy to tax, easy to regulate, and easy to generate fees from. Now, I'm not saying the 401k is worthless. The employer match is real money and it's worth capturing. The tax deferral has real value in the right situation for the right person with the right strategy around it. It has a place in the picture, but it should never be the whole picture, and it should never be accepted without understanding exactly what you're accepting. Because when you see all 5 flaws clearly, when you understand what the vehicle was actually designed to do and what it was not, you start asking different questions. Not how do I optimize inside of this system, but what does a better system look like? Here's what a better system looks like in plain terms. It produces income while you build it, not someday, now, every single month. It's not entirely dependent on government-controlled rules that can change without notice. It does not charge you a 1.5% fee per year to underperform an index. It gives you a genuine diversification, assets whose performance is driven by operating fundamentals, not public market sentiment. And it does not require depletion. The income it produces does not come from consuming the asset you built. It comes from what the asset generates, which means that asset can outlast you and pass on to your heirs and keep producing for them as well. That system actually exists. It's not exotic and it's not a secret. It's just not what your HR department hands you a form to sign up for. Building it requires a different set of decisions than the ones most people have been making. But those decisions are available to you right now. And the earlier you start making them, the more powerful the outcome. If this video opened your eyes to something in your retirement plan you had not fully considered, and I certainly hope it did, if one or more of these 5 flaws landed in a way that made you uncomfortable, I want to invite you to have a real conversation. At Elevest Capital, we work with accredited investors who are ready to build a retirement structure that does not have these 5 flaws built into it. I'm talking about income that starts right now, diversification that actually protects you, and a structure that outlasts you. The link to book a call with our team is in the description below. No pressure, just an honest conversation about what you've built, what its limitations are, and what your options look like from here. And if you just want to keep learning, subscribe to this channel because we put out new content every single week on how to think about capital, income, and building wealth that actually lasts. I'll see you on the next one.